Hey everyone, and welcome to the first DeFi Drop of 2026, featuring Christian Dumas, Head of Ecosystem at Superform, the first user-owned neobank. Anyone can save, swap, send, and earn on-chain while keeping full control of their assets. Welcome, Christian. It's fantastic to have you on.
Yeah, thanks for having me on, Edward. Yeah, really excited to be here and talk about Superform.
Awesome. Well, let's get stuck in. Actually, Superform really came on my radar in early 2025. I saw an awesome review from Stephen, DeFi Dojo. I started playing around a bit back then, entered a few positions. I noticed an awesome rebrand as well, which I absolutely love, and we can touch a bit on that in a bit. So before we get into the details, let's first hear a bit about yourself, and for anyone who's new to Superform, what Superform actually is and what kind of problem you guys are solving in DeFi right now.
Yeah, sounds great. Yeah, so I'm Christian. I'm the head of ecosystem at Superform. Um, Head of ecosystem just means I'm like managing relationships with the chains and protocols and asset issuers and infrastructure providers that we work with. There's a lot of um, moving parts in Superform and a lot of different parties that we interact with. So just managing relationships with all these people. And I do a lot of work on the community side as well, as like the community manager for Superform. And we're a smaller team, so I do basically everything on the growth side, from the marketing to the BD. I wear a lot of hats, as they say. Um, and Superform is really amazing uh, project company that I've been working at for um, 2.5 years now. I think I started in the summer of 2023. I was working at Layer Zero prior to that. Um, and Superform, for those who don't know, we're calling it the user-owned neobank. You might have heard of the neobanks as kind of the hot narrative in crypto right now. Um, and we do think it's like the direction that DeFi generally is heading. So the the main mission, to put it simply, is to make DeFi like easy and accessible for the average person when we're talking about onboarding the next billion users, as they say. And that like neobank narrative, we think, is the way that we actually bring non-crypto natives on chain. So what Superform is, it's a lot of things, but effectively, it allows you to perform like any action within DeFi within one single transaction or one single signature, to be more specific. But that's more like a technical interpretation. But you can imagine that DeFi is very complex. There's a lot of chains, there's a lot of protocols, there's a lot of different tokens, there's a lot of different interfaces. And for the average person, it's very complicated and overwhelming. DeFi does offer above average returns, but I'd say most people struggle to actually capture those because of the complexity. So Superform tries to simplify things, and our ultimate vision we're working towards is this mobile application where I can sign up with a Google account that I already own. I can onboard dollars from my bank account. I can start earning yield in DeFi, and then I can spend these yield bearing assets in the real world. So we have this full like end to end like financial experience, all packaged within this like user friendly mobile app, where really the user doesn't even need to know they're touching crypto or touching DeFi. It's just, I have money, I want to earn safe, secure returns on my money. And I want to do so as easy and seamlessly as possible. So that's the experience that Superform is trying to enable.
Thanks a lot. And you are actually enabling it really well. I've spent a bit of time on your platform recently. It's super simple and the yields are extremely attractive. I can't wait to get stuck into it more myself. So you frame Superform as, you call it, boringly reliable yield infrastructure, which, by the way, I love. You're doing this in a space that loves risk and speculation, but why do you choose to lean so hard into reliability, and how do you back that up technically?
Reliability is something that I think the average like financial participant really wants. I think the long-term vision of Superform is not really targeting your current like crypto native or like, DeFi farmer, DeFi power user. Um, those are the people who love the risk and love the speculation, but honestly, the average crypto participant probably loses money, right? Like 90% of traders lose money. Not an exact statistic, but something like that, I'm sure. And we wanted to build something different, right? Like especially if you're trying to build for, as I've said before, the next billion people coming on chain, or just like the average person who's just looking to earn safe, reliable returns. That's who it's ultimately being built for, because that is like the vast majority of people, what they want, or maybe they don't know they want it, but it's like the best for most people. These like high risk speculative bets are generally going to lose you money in the long run, unless you have an edge, which most people don't. So that's why Superform is going for reliable. I wouldn't call it boring myself, but they uh, maybe it's not, you're not going to get 100% APY kind of thing. You're not going to get a 20x by depositing in a super vault. But that's not what it's built for. So um, the the strategies that Superform builds, they're typically lower risk. We're our the current SuperVaults is like our flagship like vault product that we just launched like a new version of last month. And these are currently investing in um variable rate like lending markets, so things like Aave and Morpho. um and that's just the yields just come from borrowing demand for these assets. And there's like I mean, you can go all into how risky some of these things actually are, but generally Superform is making sure that the strategies are very attractive in terms of risk return. So again, not 100% APY, but you can get 8% APY for like very low risk. And that's what we're trying to target, just like safe, reliable returns, as I've said a couple times now, I think. And that comes down to like the types of protocols that we decide to include in these strategies. Battle tested, reliable, relatively low risk things like that have been around for a while, Aave, Morpho. And then we also can capture fixed rate premium yields through Pendle. The strategies can be expanded to go further down the risk curve potentially. And we can dive into some of this later as well, but we're going to open up these super vaults to be curated by third parties, and then they can be as risky or non-risky as the vault manager chooses them to be. But for the strategies that we're personally curating today, yeah, I mean, you could say boringly reliable, um, very safe as far as like DeFi goes.
Yeah, I think your boringly reliable catch is also tongue in cheek. It goes really well with your image, with your branding as well, but it also cements that low risk attitude that you have.
Mm.
Yeah, so you mentioned 8%. That's on the USDC, from what I remember. I just saw because I was about to deposit into it today. I think 4% on WETH, right? And you're roughly 1% on WBTC.
Yeah, so these are like the current target rates of the strategy. There is like some nuance in terms of like there's some like more like a liquid components of the strategy, like the Pendle PTs that are like capturing that fixed rate, that fixed term premium. The price of those can be volatile, so like the current APYs may not reflect like the target rate of the strategy today, but the idea is that um, over a long enough period of time, we're targeting that rate because you hold these Pendle positions to maturity. And only if you hold them to maturity, you guarantee that like higher fixed rate. We also have the ability to, like, for example, Morpho gives, in addition to the base rate, some like bonus Morpho tokens as extra incentives. And these new strategies are able to claim those rewards and sell them for more USDC and then auto compound within the strategy. So some of these things are not like yet reflected in like the live APYs. That's why like they might be like slightly lower like today, but the the target rates are the ones that you just mentioned. Yeah, 8% on stable coins, 4% on ETH, 1% on Bitcoin, for now. And like these things are dependent on many factors, especially for the lending markets. It's based on borrowing demand. Like a year ago, we saw 20% APY on USDC, and that was just because the market was going crazy and there was like a ton of demand to borrow stables, mostly for people who wanted to take a lot of risk and do like these looping strategies. But SuperVaults did benefit from that. So yeah, those are the current target rates given the current market conditions and the current components of the strategy, but they can change based on a lot of factors. And of course, we're looking to increase those, or have the highest risk adjusted returns possible. And we have people on our team always looking at like new yield opportunities and things that we can add that without taking much additional risk, increase these returns for people.
Your SuperVaults are built around ERC 7540, which standardizes how vault deposits and messaging work across chains. Under the hood, how does the ERC 7540 actually structure a SuperVault deposit? And how does that standard help you route capital and manage risk-adjusted yield across different protocols?
So before talking about 7540, I'll talk about ERC 4626 because I kind of like understand that first. So ERC 4626 is the tokenized vault standard. It's a standardized interface for yield-bearing tokens, kind of like ERC 20 is a standardized interface for fungible tokens and ERC 721 for non-fungible tokens. And this just makes it easier for applications to like interact with a wide range of tokens because it enables this like predictable behavior. You can think like OpenSea, for example, or any NFT marketplace could not function as it does today without having this ERC 721 standard, because you would need to have custom integration. Basically, you do custom development work for every single NFT collection you want to add to the marketplace because they don't have the same standardized functions, so they don't all behave in the same way, which is just number one, like onerous and would take like way too much dev time to have like I don't know how many hundreds of thousands of collections like they have on OpenSea, but like that just wouldn't be feasible without a standard. And also it's like more risky because extra development, especially smart contracts, is just going to open up more possibilities of exploits and things like that. So as that relates to ERC 4626, and then I'll get to 7540 after, this is just standardizing the way that these yield-bearing tokens work. 4626 is utilized by Morpho, by Euler, by Athena, by lots of like large protocols in the space, because it makes it really easy for other protocols building on top to like integrate. And just standards are good generally to make things more secure, safer, more seamless, and just quicker development cycles as well. So 4626, it's pretty simple. It lays out how deposits and withdrawals work for these vaults, or essentially there's a yield bearing like receipt token when you deposit into the vault, and it lays out how deposits and withdrawals work for that vault, and also for the vault accounting as yield is generated and the assets the vault owns like grow over time. So that's 4626. The limitation of 4626 is it only works for synchronous deposits and withdrawals, meaning you click deposit and you instantly have your money in the vault, or I click withdraw and I instantly have the funds in my wallet. And this is kind of limiting in a lot of ways, which is where ERC 7540 comes in. So it's an extension to 4626. It inherits all of the same like deposit and withdrawal functions, and then the accounting that I talked about. So all these things are present in 7540, which was actually co-authored by some members of the Superform team, including Vikram, the CEO. So yeah, and that's a while ago. I want to say like a couple of years ago that the standard was like formalized. So it's really exciting for us to finally be able to like build on top of it, because it was, this is kind of the vision we were working towards. So it enables asynchronous deposits and withdrawals. So in any case where there needs to be some delay between, um, you know, trying to withdraw your funds and actually receiving your funds. And this enables a lot of things within SuperVaults. So one thing is cheaper withdrawals through batching. In the V1 of our SuperVaults, which were built on that other standard 4626, they when gas was spiking, sometimes it would cost like $100 in gas to withdraw from these vaults, especially when the vault is like allocated to multiple different strategies under the hood. You have to pay the gas to like withdraw from each one of those strategies. So it gets quite expensive. But instead, if you batch withdrawals and then execute all these batch withdrawals together, like once an hour, which is what the super vaults currently do, you socialize those gas costs for the withdrawal, and it makes it a lot cheaper for everybody, especially on Ethereum mainnet. It's not a big deal today in this current environment, but if things ever heat up, we could see expensive gas again, and this is one way to make things cheaper for users. It's like $100 is like not feasible for some like smaller users, and it really prices out a lot of people from accessing these yields on Ethereum. So batching withdrawals is one thing that you can do by introducing this like asynchronicity into the vault standard. And it also lets you tap into a wider range of strategies. With a synchronous vault standard, with these ERC4626 vaults, you can't really tap into things like say like an RWA strategy, for example. Like these are often illiquid, so my funds might be locked for 3 months, 6 months, 12 months, while I'm earning higher than average returns. But I'm paying for that by having my funds unavailable to me for a certain period of time. And that wouldn't work in a synchronous vault, in a 4626 vault, because I would try to withdraw and there'd be no liquidity for me to withdraw. So the withdrawal would revert. And so the vault just wouldn't work in that case. Or you can imagine like a cross chain strategy, like there's asynchronicity when we're going across chains. So a 4626 vault cannot do anything outside of the chain that it's deployed on. A 7540 vault could. Again, because I request a withdrawal from the vault, and then the vault manager, if needed, is able to move funds around or otherwise like unwind strategies if necessary to make sure that liquidity is available for the user. So to sum up, the 7540 standard allows more strategies, so the vault can chase higher risk-adjusted yields by having that flexibility where the vault manager can kind of is able to process these redemptions when needed, to avoid these like illiquidity issues, and also it allows for these batch redemptions that makes gas cheaper. So what that looks like for a super vault transaction, the deposits are still synchronous. So it's just I click deposit, and under the hood, the contract has this deposit function, and my money goes from my wallet into the vault, and the vault gives me this receipt token, and that receipt token accrues value over time. The 7540 standard, the difference comes in on the withdrawals. Like I mentioned, there's this like redemption queue. So I would request a redemption, and it goes into this queue. It's batched with a bunch of other redemptions, and then usually once per hour, those are all executed, and I would get my funds back within an hour. If it's a very large withdrawal and the vault doesn't have enough liquid assets to process that, it could take longer in the case that, say, we're allocated to Pendle PTs, and ideally those are held till maturity. If somebody wants to withdraw so much that the strategy needs to like unwind these Pendle positions, then that might take a little longer because you don't want to instantly process that. There might be slippage that causes the strategy to lose money. Or if there's like again these like RWA strategies where your funds are locked for multiple months, so it could take like a few days to unwind a very large withdrawal potentially. Like we haven't seen that yet, but it's theoretically possible. But generally these are processed within 1 hour.
But I love that. You have your own bundling and you sort of check out like a shopping cart in simple terms. We're obviously big fans of the 4626 portals. It's the backbone. and obviously it's the most popular across the space. But yeah, great to see this initiative and what you guys have built here, and awesome that you were part of the actual design of it a couple of years ago. Kudos to you guys. Anyway, I'll crack on. So you're live across multiple chains and abstract a lot of the cross-chain complexity away from users. What does a single Superform deposit look like technically, and what's happening step by step behind the scenes? I think we've just covered that.
I can look at it from like a different approach, because that was like specifically a ERC 7540 deposit. But the Superform protocol itself has a few other things that we can talk about. So, number one, every single transaction on Superform is routed through a smart account. So when you're interacting with Superform, either you will first create like we call it like an embedded wallet, which is like a Superform account. It's a specific smart account that is specific to the Superform application. Or you can connect an EOA that you already have, but even in that case, you're still going to route the transaction through another account, which is a smart account, which we call these companion accounts, because to do all these advanced cross-chain interactions and to have everything occur in one transaction or with one single signature, an EOA can't do that. So we need to use smart accounts. So what happens is let me think how to best explain this. So on Superform, you can do theoretically anything in DeFi with multiple assets across multiple chains and protocols, and all this can be executed with one single signature. So I could have USDC on Base, and I could have wrapped Ethereum on Arbitrum, and I could take both of those assets and I could fund a deposit into two different vaults, say a vault on Optimism and another vault on Polygon, just to throw a couple chains out there. So I can do all of that. So I have assets on two different chains, and I'm going to deposit into two vaults on two other chains. And all of that can be done with it. I can just do one signature and it's all going to be executed. So we have, because we're working with like smart accounts, if you're familiar with how those work, there's like there's a bundler, which is going to take, we call them user ops. You can kind of think of it like your intent. Like my intent is I have an asset here, and I want to deposit into a vault here and a vault here. And that's what I want to do. And these are my intents. So all of these are user ops, and then these get put into this this kind of separate pool where the super bundler, we call it, which is our own like bundler that we run, is going to construct this transaction across chains to facilitate this. From the user perspective, I'm just clicking. I'm just signing. I'm signing one single message. I'm on through the UI. I'm specifying my intent, and then I'm signing one message. But under the hood, we have the super bundler that's actually constructing the transaction. And then the smart account is what's able to like execute these across chains. And because we're using the smart account, I don't need to sign like another message when the assets reach the destination chain. I can just sign one single time um, on the source chain, and then everything that I intend to happen is all just executed under the hood. Um, and we have the protocol, the Superform protocol, that obviously like enables this smart contract functionality and all these things to occur. And then we have this off-chain infrastructure, which is the super bundler, which is taking those intents, taking those user ops, and then structuring them so that the smart account can like actually execute everything. Um, Hopefully that's clear. This is like one of the more like complicated things, and this is why we take these like this very complicated thing under the hood. Like you still go back to saying it's like boring, right? Like I think it's like super fascinating actually, right? But like it's boring because we make it super seamless and simple, and I can just press a couple buttons and make all this magic happen. But under the hood, there's like a lot of stuff going on to enable it with the smart accounts, with the bundler.
Okay, it's fascinating. There's nothing boring about it, right? But I guess you're packaging it up to an audience that wants to make it sound simple,
Yeah,
so they're
exactly.
not put off. So it onboards those billion users. But what happens if one part of that cross-chain execution fails mid-process?
So yeah, we have like a refund system in place. So if any it kind of depends exactly what the intent you're trying to fulfill is. Um, in the simplest scenario, say something fails on the destination chain, you would just receive a refund, or you would receive your funds on that destination chain in your smart account. Um, it kind of depends on like where in the transaction it fails. It could be on the source chain and you would just receive the funds on the source chain. It could be that part of the transaction does execute and part doesn't. Like if I'm depositing into like
Hmm.
two different
Hmm.
vaults, like it could be possible. So it really depends on like what the exact transaction is, what you're trying to do. But in all cases, the funds are just returned to you on whatever chain the transaction fails on.
All right, cool. Thank you. So moving on to risk management. How do you think about risk management when you're actually aggregating yield from many protocols and chains, which you are all the time? But what are your non-negotiables before a strategy or a vault gets listed on Superform?
The biggest one that is currently a blocker, in the long term it won't be. It has to be an ERC 4626 vault. Like we talked about before, Superform can't function, or eventually again will evolve beyond this constraint. But um, Superform, as it currently is today, like can't function unless the vaults are standardized. Again, because we need to be interacting with these tokens that have predictable behavior. They all have the same functions. The protocol is extensible, so like we built Superform V2, like the most recent version, to be like future proof. So um, they'll never need to be a Superform V3, and anything non-standard or maybe some other standard. There's like the boring vault standard, for example. Like we can write, we call it like a hook, and it's like just a lightweight smart contract that allows this new functionality to be accessed by the core protocol. Um, that's kind of an aside, but just to say that like eventually this won't be a blocker, but today it is. We need the vault to be ERC 4626. Um, there's kind of two ways to look at that question specifically, because number one, Superform does have qualities of like a yield aggregator. So we have over 1,000 different vault products that you can access through Superform across like 8 different chains, and um, it's hard to like perfectly curate that many different products. So we've taken the stance that you know we're a little more conservative with the V2, but go back to Superform V1, it was actually totally permissionless to list a vault on Superform, and an ERC 4626 vault, because of the way we built it, you can actually add that with no code. Like I'm not a developer, I listed probably half the vaults um, on Superform, and even some teams that like some external teams listed their own vaults, and again, it was just through the UI, no code needed, fully permissionless. We did take one opinion where we need to like know the team. So by default, if you add a vault to Superform, it is unauthenticated. And then to become authenticated, that's a manual check on our side. And by default, we hide the unauthenticated vaults on the front end. So we at least need to know who you are. We have like a minor like TVL threshold. You have to be on DeFi Llama. You have to have some public track record. Um, not be super sketchy. Even then, like there has been a couple cases where, when you have that many vaults, like in DeFi, things go wrong sometimes, unfortunately. Um, so that system's not perfect, but generally, we've been able to avoid most issues just because of that like simple check. Like, hey, are you like legit person building in the space? Do people know who you are? So that's on like the yield aggregation side. Much more strict would be including these products in the SuperVault strategies. So we have the Superform core protocol, which enables this like cross-chain yield routing, and it's this like interface for accessing all these different products across chains. And I just described kind of the curation process for that. Then on top of that layer, we have the SuperVaults, which is our vault infrastructure product that it creates these strategies that kind of reallocates user funds across the different products that are part of that like core layer. So in that case, we're a lot more strict with what's included in there. You can see the current list of protocols that are whitelisted for these strategies. It's like battle tested, heavily audited, highly trusted protocols. So like Euler, Morpho, Aave, Pendle, Fluid, Gearbox. So these are like, they've been around for a long time. They've been audited a bunch of times. We know the teams personally very well. So that's like one thing, like on the protocol level, that's kind of how we decide which protocols to add. And then we have like a due diligence process for if we're ever going to add new protocols to one of these strategies. Also on like the vault level or the curator level. So say Morpho, for example, like Morpho protocol, we think it's like, super battle tested, secure, reliable. But within that, they have their own like permissionless system where they have all these different curators like Gauntlet and Stakehouse, etc., who curate their own vaults within Morpho. Um, so on that side, we don't just whitelist like every single Morpho vault. We have to go one level deeper and say, okay, this vault is managed by like Gauntlet. We know the Gauntlet team well. So generally, we would trust any vaults that they are managing, and those could be whitelisted for the strategy. Maybe some other curator that we don't know that well, we would have to do like a more rigorous due diligence process on this vault, looking into like what the structure of the vault is, what's the collateral of the vault. So we do have a DD process for these types of things, and we do lean more conservative again because these are like these boringly reliable strategies that are looking to just like make you a decent return while not risking all of your capital, right? So generally, yeah, we have a DD process for protocols, for vaults, for curators, and it's we're trying to get connected with these teams. Like we know most people of the space, honestly. So being able to just like reach out to them if we have any questions about things, and working closely with all these different teams that are part of these strategies. That's how we would manage risk, like just having all these connections and doing this due diligence and having this like high bar for what strategies actually end up within our super vaults.
Like you've just said, you're partnered with the best people, so you're
Yeah.
you're getting into these strategies and these positions with the battle tested, right? Um, Christian, you're fascinating. Are you sure you're not head of product?
Yeah, I just do a lot of things. We're a small team. I'm a Superform power user. I have to understand how it works because I'm always interacting with partners in the community. So I would consider myself a Superform expert, but yeah,
Right.
definitely didn't build the thing. I got way smarter people on my team who are doing
I'm
that.
kidding. But on the messaging side of things, you also mentioned no drama, which I love. Things just work. These are all great things. What have you learned from previous DeFi UX failures, and how has that like helped you shape this design of Superform's flow and guardrails?
So the original mission, like I mentioned in the beginning, was just to make DeFi super simple for the average person. Two of the co-founders, Blake and Vic, they were formerly running the DeFi team at Block Tower Capital, and they had this large balance that they were working with, managing funds across like I think like 15 different blockchains or something like this, and that was a pain in the ass. And they were thinking, okay, well, if this is this complicated for us, like imagine how hard this is for the average user. And that's kind of the vision, the idea that birthed Superform. Like we have all these chains, we have all these protocols, we have all these assets, et cetera, all these different applications and interfaces. And wanting to bring that all into one place and simplify it as much as possible. So in our V1, that started with, okay, like you say you had this position on fluid that you forgot about and you got liquidated, right? Like that shouldn't happen. Like and that you can just like multiply that. Oh, I have positions on like 20, 30, 40 different protocols. I'm a DeFi farmer. I got stuff everywhere. And like, how do I keep track of this all? Right? It's not easy. So what if we could just have all of that in one single place? So on Superform, we aggregate a bunch of different yield, and you can deposit and into it all through Superform. You can view your multi-chain, multi-protocol portfolio in one single place, so you don't forget about these positions. They're all just like, you just go to Superform, everything's right there. Um, and um, also on like the cross chain transaction side, right? Like it's really annoying trying to manage positions across chains because I have to have gas on all these chains. I have to have um, I have to be able to like remember like where my funds are on what chain. Even going beyond, I have positions on like, we're today like 30, 40 different protocols, and now all that's multiplied by the number of chains that I'm interacting with, and it just becomes like super complex. And then trying to deposit across chains. I have to bridge. Maybe I have to do a swap. Um, Maybe I have to swap on both chains, source chain, destination chain. And then once I get to the destination chain, I have to make sure I have gas on that chain, and then I have to do the deposit. And then if I ever want to undo that, it's the same thing. I have to withdraw, I have to swap, I have to bridge and get all the way over there. So that's onerous as well. So what if you can boil that down to one single transaction? What if I can do a cross-chain deposit, cross-chain withdrawal in one single transaction? So Superform V1 accomplished that really well. And then Superform V2 is the next step. Like, what if I could do anything in DeFi in one transaction? What if I could have multiple funding assets on multiple different chains and deposit into multiple vaults on different chains? And then after that, take on like this, like leverage up, like borrow against my position and re-enter it. And then I don't want to take that much risk. So now I'm going to add insurance to my position. I'm going to go through like open cover and get some insurance on this. And that whole thing can be done in one single transaction. Anytime I want to make any adjustments, I want to like rebalance that like portfolio I've just created, even across chains. I can do that in one transaction again as well. So trying to take this like complexity of DeFi and all these steps and all these different platforms, and there's just so much. And how do I boil this down to like its simplest component? And then how do I make this like interface like, accessible to people? The average person outside of crypto is never going to want to manage their private key, right? Like that's just not something feasible that you can expect billions of people to be like writing down their seed phrase on paper. So what if I could just, everyone has a Google account. What if I can just connect my Google account to Superform, and now I'm logged in, and now I can send my money there, and now I can start on the desktop, on the web app, I can create my account, and then, oh, I'm on the go. I need to like rebalance my portfolio and I check my positions. Or I can just go on my mobile app. I can also log in with the same Google account, and now I see everything there. It's seamless between the two platforms. And going back to just being able to do anything in one transaction. So um, all of that is kind of on like the general UX of DeFi and how we're trying to improve upon it, and ultimately go from, going back to like that neobank idea. How do I go from cash to crypto, to earning yield on crypto, to spending that in the real world uh, on my mobile phone in just a few taps? And that's like the ultimate vision. So, and that's where we think DeFi is needing to go to really onboard everybody and become part of like this like mainstream adoption, right?
Yeah, yeah. If you zoom out a bit, where do you think this deposit into a vault once, get optimized forever fits into the broader DeFi stack over the next cycle? Do most users end up in this kind of abstraction layer by default?
I would say yes. Again, you're always going to have like DeFi power users um, who want to be like managing all their stuff and like jumping between protocols and um, not being beholden to like what a vault manager wants to do. Like they think they can outperform a vault, which maybe if you have an edge, maybe you can. But we're building for the masses, right? Like even we're not thinking of who's using crypto today. It's a very small group of people. Um, and like you said earlier, like a lot of them want risk and speculation, and that's not what we're really providing here.
Mm.
Um, so the we're really trying to think about these. I keep going back to like the next billion users coming. And yes, I think those people like think what does the average investor in like traditional finance do? They have mutual funds, they have ETFs, and these are just like broad market indexes that um, are given this exposure. It's relatively low risk, and most importantly, it takes like zero mental effort. It's just like, here's my money, go nuts, right? And that's what most people want. Most people, like I personally, I love messing around with all these different protocols and seeing what's going on, losing money here, losing money there, like just having fun, like experimenting. But that's because I love finance and I love crypto and I love the tech. Most people don't give a shit, to be honest, right? Like they just want to like put my money somewhere and I want it to reliably earn me money. I'm gonna put my money here, and if I check it a year later, I have a little bit more money. That's what most people want, honestly. Um, and that's kind of what we're trying to give them. And I think that, yes, like to directly answer your question, like most people in the future will be in these automated DeFi vaults and not be doing any sort of like manual DeFi labor by themselves.
And I would say getting over those October 10 events, these Black Swan events, they come out in the press. DeFi users and non-crypto native see these, and that also puts them off, right? I think we've got to try and cement into the new wave of users that are coming is trust and the low risk aspect of a lot of these strategies and positions, because the tech is phenomenal and it's moving at an absolute rate. So
Hmm.
we're certainly going to fix a huge amount of these concerns for new users. If you look at all these big names, yourselves included, nothing happened during 1010, and
Yeah.
people just stood their ground, battle tested, and I think this was a good sign. It wasn't great for everyone. It was bad for a lot of people.
No.
Look, I don't want to go on too long. It's been fascinating. I've loved getting into the details of Superform, but I just want to thank you for jumping on the pod, and I just want to give you our final question. Okay. It's a bit of a game. We had our first iteration of it actually in 2025, but I'll hit you with this question now, which is, according to DeFi Llama, the total TVL of DeFi is 130 billion. What's your prediction for this number on the 21st of June, 2026? So we're splitting the year in half.
6 months from now.
Yeah, let's go.
Um,
Let's go 21st of June. We're going by the solstice. We're not going by New Year. We're going by solstices.
So it's currently 130 billion, and the peak was about 170 billion or so.
Yeah,
That was just
174 or 76, I think, is the
oh,
all-time high.
actually, on looks like about October 10th is actually when we were at that last peak there. Okay, so I'm pretty bullish. I think there's a lot of like great catalysts coming that will definitely get us like new DeFi TVL all-time highs this year. Um, that would be my bet. By June, my estimate would be 200 billion TVL. That's unreasonable.
That's nice. It's not
Yeah.
unreasonable.
That'd be great. Maybe higher by the end of the year, but by June, let's say 200.
Okay, cool. It's a great game actually, because no one knows. Anything can happen. We were on an amazing streak when we started the DeFi drop in the summer of 2025. Everyone was super bullish and everything was going great, and then 1010 happened, and then you had these late November crashes.
Hmm.
So suddenly every week when I did a recording, that number came down and down and down. But hopefully we see better times towards the first half of this year. Yeah. Well, thank you very much, Christian. It's been great having you on, and hope everything at Superform goes according to plan.
Thanks, Edward. Really appreciate giving me the platform to talk about Superform. It's been good.
Thank you. Thanks a lot.